Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. When we buy a property, we often get a loan, but there's a lot more to financing than just the loan on the property you're buying right now. Today, we're going to talk about equity management strategies to unlock the power of your balance sheet. And we've got an awesome guest on the Real Estate Guys radio program. Registration is now open for the Real Estate Guys 20th Annual Investors Summit. Imagine spending an entire week with like-minded investors, world-class educators, and real-world professionals. Returning in 2022, the editor of the Gold newsletter, Brian London, international real estate developer Beth Clifford, the author of The Creature from Jekyll Island, G. Edward Griffin, Jim Rohn's 18-year business partner, Kyle Wilson, and the rebel capitalist, George Gammon. And joining us live and in person for his 10th Investors Summit, best-selling author and the Rich Dad advisor for real estate, Ken McElroy. Plus, lots more to be announced. It all begins June 10th, 2022 in beautiful Belize. Visit realestateguysradio.com and click the tab that says Summit to reserve your spot. Go to realestateguysradio.com, click Summit, and make plans to spend a week with the Real Estate Guys, George Gammon, Ken McElroy, and an all-star faculty on the 20th Annual Investor Summit on Sand. Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms, and joining me as usual, it's our co-host, financial strategist, Russell Gray.
Hey, Robert.
Lots of ways to buy real estate. You can buy for all cash. You can maybe trade somebody for a cow. But most people use financing, and today we're going to talk about not just how you finance your real estate, but really how you strategically design purchase after purchase to use your equity and everything else on your balance sheet and your financial statement to put you in a better position. And this is right up your alley, Russ, as the financial strategist.
It is. This is really where I started. When I got into real estate investing, I quickly realized that the key was debt, that you really had to master the art of debt. And I thought, well, the best way to master that is to be in the business. So I got into the mortgage brokerage business so that I could be in the debt business and really understand the loan programs, the underwriting guidelines. And, you know, when I got into the space, what I realized is that 99.9% of the people, and I'm not trying to disparage them in any way, but they were really focused on taking applications, meeting underwriting guidelines, quoting rates, dealing with each transaction, one transaction at a time. And that was something that I saw that was really going on throughout the real estate business. It was a very transactionally oriented business. And Robert, when you and I got together, I kind of came in with this financial strategy. Hey, look, the mortgages are just a tool, and we're managing a portfolio and a relationship for a lifetime. You were in the education business, and I had a plan for education, and we got together and started teaching together. A couple of years after that, you know, I became the co-host of the show, and the rest, as they say, is history. But along the way, I've always had this desire to see somebody step back in and meet that need in the marketplace, how people can look at their financial statements and get more out of them. That's really kind of still a lost art. And the mortgage business changed a lot after Dodd-Frank, and you have to be more creative about how you do it and the people that can support you. But we've been working on that, and we found some solutions, and we're excited to talk about that today.
So there's so much involved when you buy a piece of real estate, and I think you bring a great point, which is that for most people, it's a transaction. I'm going to get a lender, I'm going to get a loan, I'm going to refi, maybe with the same person, maybe not. It's whoever has the best rate and the best terms. And yeah, we started approaching it very differently. I remember back in the day when we were just in one market on one radio station before there were podcasts. We would have a course of education people would go through, and then they'd want to figure out how they could actually deploy their assets into real estate. And we started doing these consultations. People would sit with us, and there'd be 3 or 4 of us, and we'd look at what they had and where they were trying to go. And more times than not, you were able to recognize on their financial statement and their balance sheet hidden gems, places where they had more power than they thought they did financially. And then we started teaching these concepts of taking the equity in your property, the part that either you originally put down or that the market gives you, that over time is created by cash flow, that equity to better use. And that's done through financing.
Yeah, well, when I really started developing financial strategies for real assets or real estate and using mortgages, I looked at what people were doing in the paper asset world, and I said, well, what applies? And so there was some portfolio theory and being on the debt and the equity side. It was about cash flow versus equity growth. But really what it came down to was the use of a concept called arbitrage. And the people who trade bonds and a lot of the stuff that goes on the debt side of the business, the more I studied the bond market and bond trading and the way people play the game, it was this concept of arbitrage, which is really a basic concept. And we see it every day and we recognize it. We go put our money in the bank and the bank gives us 1% interest. And then we borrow money from the bank to buy a car and they charge us 5%. They make money on that spread. And then they add leverage with fractional reserve banking to magnify that spread. Now, there's a lot of things that are wrong with the way that game is played, creates a lot of fragility in the financial system. But this is the way the people who deal in the paper worlds, who manage equity, if you will, in terms of balance sheet equity, get more yield out of it. And I thought, is there a way to apply that to a real estate investor's portfolio? And the answer is yes. And the key is mortgages. And when you understand that residential mortgages in particular are government subsidized, 30-year fixed, which is a very long period of time, backed up by a real asset, and you get to purchase the tax breaks and the cash flows to do the debt service. The question is now, what can I do to make a positive spread on that equity that I've now released? And that's really what these mortgage or equity strategies are all about. And you can go a lot of different directions with it, but that's the fundamental core.
When we look at purchasing a piece of real estate, it's going to fit in our portfolio and our lifestyle somehow. And it's different when I'm buying a house to live in or a vacation property than it is when I'm buying an investment property. And the challenge we often have when arranging for financing is the types of lenders that do homeowner occupied loans tend to be different than the lenders that do investment property. At the very least, your lenders should be talking to each other. But the other part of it is that you are painting a financial picture every day of your life with the way that you create income and the expenses you take and your tax returns. For instance, most people would like to have as many deductions as possible and show as little income as possible, legally, of course. But that's not always the best way to look good to a lender. So there's a lot to think of beyond what's the price and what are the terms.
Absolutely. I mean, if you think about just from the tax point of view, and I'm really glad you brought that up, Robert, if you can save $3,600 a year on taxes, $300 a month, and I know these numbers just off the top of my head from back in the day when I was doing this actively as a mortgage broker. But at 6%, 30-year fully amortized, that $300 a month will control $50,000 of mortgage money. Well, that $50,000 of mortgage money will control $50,000 of real estate, which means whatever derivative of income is coming in off that $50,000, whatever percentage of tax breaks come in. So you're actually using tax breaks to purchase more tax breaks and more income. And then there's an ROI on that. And in some cases, you actually can make a profit by paying the tax in order to be able to qualify to get more mortgages. And so these things are done strategically. It's like with your retirement plan. If you have a retirement plan, you may decide, hey, I'm going to put a bunch of money in my retirement plan as a traditional and get the write-off right now. And then you may work your portfolio through purchasing tax-advantaged investments to where your taxable income one year is very, very low. And then during that year, you roll your traditional IRA over to a Roth IRA because you don't take much of a tax hit. And then you're able to grow the rest of the equity inside and make those capital gains inside of a Roth, which is completely tax-free. So it's the idea of being strategic, timing when and how much you pay tax, why you pay tax, how that affects your lending, and then how do you maximize your ability to take the biggest bite out of the cheapest money pie that you possibly can. And this is the challenge that a lot of people have. Investors have to think about this. Homeowners don't. Homeowners are going to buy a home, and then maybe 3 to 5 years later, they're going to refinance or they're going to sell and buy a new home and get a new loan, and that's it, right? A very simple business. But when you're really being aggressive with your borrowing as an investor, you've got to be thinking about the third, the fourth, the fifth, the 10th loan when you're doing the first one. And you really need to think about getting your financial statement in position to be able to borrow optimally 2 years in advance, because you have to build a 2-year credit history to show the underwriting in order to qualify for the loan. Of course, that's always a moving target, which is why your relationship with your mortgage professional is not transactional. They're literally your mentor when it comes to managing your borrowing power, which is arguably your most important financial asset, especially as a residential 1 to 4 investor.
And all lenders are not created equal. Anyone who has ever done more than one loan probably knows this, but I remember when I started selling real estate, people came to us first. They wanted the house. They didn't want the loan. They wanted the house. They'd find a beautiful house. They'd figure out approximately what they thought they could afford. And then once we had the house under contract, well, then they talk to a lender, either someone they already knew or someone we introduced them to. And that's backwards. Really, even to buy your single family house, you ought to start with the lender so you can be what they call pre-qualified. So you know, what can I really afford? And how's the lender going to view my income and my credit history and all the parts of my financial life? And that's magnified for real estate investors. As you said, Russ, you have to start 2 years ahead of time. Well, most people don't. Most people get into a loan, maybe not a great one, buy another property, end up with even worse financing, and then it dawns on them, wow, if I was a little more strategic about this, I could get a better interest rate, I could have better loans, I could figure out how to manage my equity. That's what we're going to talk about today. Russ no longer is in the mortgage business, so no, you can't sit down with him and do one of those consultations he used to do. But the good news is we have an amazing gal with us who was trained by Russ for the last 20 years. When we come back, you're going to meet Stephanie Riley today on the Real Estate Guys radio program.
Real estate investment advice right in your mailbox. Sign up for the free Real Estate Guys newsletter at realestateguysradio.com.
Hey, it's Robert Helms. Thanks so much for listening to the show today. I want to personally invite you to come see an amazing real estate market that combines excellent cash flow, offshore diversification, and what we affectionately call lifestyle investing. Come join me December 3rd through 6th in the beautiful country of Belize. The Real Estate Guys have been bringing investors to Belize for more than 15 years now, and our discovery trip is designed to show you the market like nobody else can. Sure, Belize is breathtakingly beautiful. The people are wonderful, and wait till you taste the food. But the real opportunity is the real estate investment potential. Demand for offshore real estate has skyrocketed since the coronavirus shutdown, and with retirees looking for lifestyle, the work-from-home workforce able to be productive from afar, and tourism coming back strong, now may be the perfect time to consider Belize as a place to diversify risk in your investment portfolio. There's all types of opportunity in Belize when it comes to real estate investing, including both long-term and short-term rentals, commercial and retail triple net properties, business opportunities, land acquisition, development, agriculture, and more. And as the only country in Latin America with English as its official language, it's easy to understand the law. Property rights are strong, and contracts are in English. And in Ambergris Caye, a unique situation exists where demand for rentals continues to outstrip supply, creating a compelling environment for investors. So come see for yourself. Join me in December in Ambergris Caye, Belize, as we study the market, learn about the sustainable drivers, and tour lots of beautiful real estate. And like all of our field trips, there are no properties for sale during the weekend. Rather, you'll meet lots of local providers that will help educate you about the market so that you can follow up with them after the trip if the market is interesting to you. You've heard about Belize and the Real Estate Guys for all these years. Now come see what all the excitement is about. Plus, we'll have lots of time over meals and activities to talk about all things real estate. To get the details, go to the website at realestateguysradio.com and click on events where you'll find the Belize Discovery Trip. Once you register, you'll get information about our group hotel rates, as well as full travel details. So join me in Belize December 3rd to 6th. It's a beautiful country with lots of amazing possibilities, and the only thing missing is you. Go to realestateguysradio.com under events, and I look forward to seeing you in beautiful Belize.
Hey everybody, it's Ken McElroy, and I'm on with the Real Estate Guys, and I'm very excited to be a guest and a speaker at the Investor Summit on the Sand in Belize coming up. If you haven't signed up, be sure to do so.
Welcome back to the Real Estate Guys radio program, now in our 25th year of broadcast. We're so glad you've tuned in today, and it's an awesome show. We're talking about managing your equity and using loans and lending to increase your portfolio, probably in some ways you haven't even thought of. To help us do that, please welcome back to the Real Estate Guys radio program, Stephanie Riley. Hey, Stephanie.
Hi, it's good to be here.
Well, it's been a while. We see you from time to time, but it's actually been many years since you've been on the radio. Stephanie's part of the equity strategy team with USA Mortgage, and you help people not only get loans, but really the bigger picture is figuring out the things we were talking about, taking a portfolio approach to acquiring real estate. But before we go down that path, you started in the mortgage business many, many, many years ago, and it's very different then. Not only the types of loans that were available, but disclosures and laws and blah blah blah. Kind of paint the picture of the changes that you've seen, and maybe recently things people need to be aware of when it comes to financing real estate.
You're exactly right. 20 years ago, there were loans that they had stated income loans. You just tell them what you make. They don't need to verify it. They had Nina loans. No income, no assets. You can fog a mirror, you can get a loan. It was very easy to get loans done. Today, there's a very different landscape. So if you're looking at getting government-backed financing, Fannie Mae, Freddie Mac, conventional conforming financing, you're always talking about full doc loans. You've got to prove that income. And so that involves a lot of creativity sometimes, especially for real estate investors. Many real estate investors happen to be self-employed business owners, and that creates a lot of mess when it comes to loan packaging. And yet it can get really fun to be creative and figure out how you can get these packages to go full doc.
Well, in big picture, I don't think it's a bad thing, right? I mean, we were all beneficiaries in a way of those easy loans, but we also, saw the downside of that leverage. While we love it because it magnifies returns, it is a double-edged sword. And so I'm not completely opposed to having it be a little harder for folks to get loans. If you think about the lender's position, what a lender does is wants to make sure that you can pay them back, and they want to be protected in case you can't. And today that just means paperwork. And again, at the end of the day, we want the same thing. The lender wants to put the money to work. They want to make the loan, and we want the leverage. We want the debt. So as long as you go in with a healthy attitude about that, the fact that there's a few more hoops to jump through and more paperwork, well, that's just one thing you got to deal with.
It is. And, it's become a more heavily regulated industry. For example, when I talk about soliciting any kind of financing or talking about financing, I have to tell you my NMLS number is 2047373. So you know who you're working with. It takes care of the legal part of things.
And that does make sense, right? Again, we want to do business with people that are reputable, and this is a long-term business. At least it should be. You should develop a relationship with somebody that can help guide you through this, as opposed to popping around from internet site to internet site based on who has the latest rates. So talk about that, because rates are at an all-time low. Maybe not at the absolute bottom, but all things being equal, rates are pretty low today, but there's more to a loan than just the interest rate.
There really is. And that's something that a lot of folks, when you're getting financing, don't realize, is that you may decide to pay a higher rate in order to get more leverage on a property because your overall return is going to be better on that equity growth if you're able to take advantage of other people's money and use less of your own. So, leverage is a huge one. Another one can be if you want to get loans in the name of an LLC, or you want no prepayment penalty. There's all kinds of different terms that loans come with. But conventional loans today are 30-year fixed. So again, this is kind of the change in the landscape from years and years ago. Is today a lot of the financing is standard 30-year fixed for conforming loans. But that doesn't take out the importance of being able to figure out how to use that financing to really grow your wealth.
Well, and that's a great point. Full disclosure, you've done loans for me in the past, and I remember a lot of the times we would look at the variable rate, the adjustable rate mortgages compared to what the fixed rate was then, and you'd ask me about my timeline, how long I want to be in the property, those kinds of things. And many times it made better sense to go with an adjustable rate mortgage or one of those teaser rates, something like that. Today, with rates as low as they are, you could definitely make the argument, no, fixed is so much safer and more secure. And so the landscape does change. We don't know when you're listening to this program. If you're listening in the current rotation, so to speak, well, then you're right with us. But because loan programs can and do change, it is important that you find out. And it really depends so much on the individual borrower. So if we can, Steph, let's start here. We've got people listening that don't yet own an investment property. Maybe they bought a house and maybe they're just renting. So you see people that come to you who have a portfolio already. I know we spend a lot of your time, and we'll talk about that today, about taking someone's existing portfolio and how they're using their loans and their equity and crafting a strategy. But before we even get to there, when someone is just eager and out to buy a property and they find a great market and they want to find a property, what are the things they need to know about the loan before they make an offer?
Well, the biggest thing, if they're a first-time home buyer, a lot of times in that particular situation, first-time home buyers often don't have a lot of down payment saved up. What if they're a first-time home buyer, or even not a first-time home buyer, just a renter looking to buy a home, and at the same time wanting to become a real estate investor? That is awesome because we can take advantage of the owner-occupied great rates, high leverage financing available, and marry that to an investment property. So let's say you're buying an owner-occupied duplex, triplex, fourplex, where if you were to walk in and buy that as an investment property, you might need to put 20-25% down. If you're buying it as an owner-occupied property, now there's programs you could get in with 3.5% down. So that is a huge opportunity if anyone is just getting into buying a primary residence and investment property. That's a big jump start to building an investment portfolio.
That's a great idea, especially if you're willing to live. And I've lived in some of my buildings before, and I wouldn't necessarily recommend that, but it certainly can be a great way to start. And then there's all kinds of ways that once you're in and you are making your payments and you're painting this financial picture, that you can continue to acquire assets quickly. We certainly have listeners that buy an investment property every 3 to 5 years. Okay, well, if you've got a good job and good credit and you're not making any financial mistakes, that's pretty easy to do. But we also run into folks who are more aggressive than that. And talk about that end of it. If I catch the real estate bug and maybe I've got some money saved up, qualifying often is the wall I run into, not necessarily down payment.
Exactly. Yeah. And if you're rapidly acquiring properties, it really is important to plan out those acquisitions and that financing and not just calculate how you're going to qualify for the first one, but how are you going to qualify for the fifth, sixth one. And maybe in some cases, all the time, our team does loans for folks simultaneously. So we might be cash out refinancing 3 or 4 properties at the same time we're pre-approving and they're shopping for another purchase. All of these things can happen at the same time. I'm fortunate to be a part of a team where we have the reach to lend in 48 states. So the ability to manage all of that at the same time can help. But you really want to be looking at how are you going to meet? A big one is debt to income ratio and cash reserves. The more properties you own, the greater reserves the lender's going to want to see. And the more properties you own, depending on whether they positive cash flow or negative cash flow, that's going to have impact on your debt to income ratio. And so planning out the financing and how you, like to your point, Robert, how you approach the rate and points with that financing, it doesn't just impact the interest expense on a particular loan, though it does, but it also impacts your debt to income ratio on a future purchase. And so if you know that your limiting factor on a future purchase is going to be cash flow and debt to income ratio, then you may choose to part with some cash to lower a rate to get that cash flow in a better position. Or if your limiting factor for your next acquisition is cash and cash reserves, you might say, okay, I've got some room in my debt to income ratio. I'll accept a little higher interest rate to preserve some capital because that's the limiting factor for me in continuing to acquire more properties.
You know, you've heard Russ say, do the math, and the math will tell you what to do probably as many times as I have. And absolutely, you got to crunch the numbers. But I think there's one more layer on it, which is your mortgage professional is going to guide you into the kinds of decisions you just talked about. That's not obvious to me that I should, if I put a little more down, I might affect my future purchase. And I know you spend a lot of time with investors that already have a portfolio, and they come to you and they say, well, I've got this property in this city and it's financed this way. And I've got this other property and it's got a balloon payment coming due. And then I've got this third property that was, we haven't really, refinanced in years. What are we talking about in terms of the amount of time it takes for you to comb through all that and come up with some potential options for an investor?
Yeah, you hit the nail on the head. It takes time, but it's so fun. And really what we do is it's really based on if the client is willing to put in the time to give us the documentation, and we really need the documentation. If they will give us all the documentation we need, and we have that, it can take us anywhere from 24 to 72 hours to comb through all of that and then figure out what we could do to optimize things. So our team will go through each and every mortgage statement. We'll go through valuations and equity. We fill out what I call a financial snapshot. And so this is where we're looking at two parts of this. We're looking at what do you have to work with that you may be underutilized, cash flow that's allocated at a place that's not optimal, equity that's sitting idle, not working for you, retirement funds that are just sitting doing nothing because you don't want to expose them to the stock market maybe. We analyze all of that, your cash flow, equity, and credit, and we do this with you. At the end of that, you come up with what you want to do. But then there's a second part because it's sort of like a SWOT analysis, right? Strengths, weaknesses, opportunities, and threats. Because you can want to lever up to the hilt. You can want to spend every penny purchasing investment properties. But is that really secure for your long-term portfolio? Because there could be turnover. There could be a tenant that gets COVID. There could be these things that pop up and you didn't see coming. And so one of the other benefits of doing this kind of analysis is not just getting into what can I do more, but where is my portfolio possibly exposed and what could I do to strengthen my portfolio, both my liquid reserves, my cash flow, and that sort of thing.
Such good points. When people buy their first or second investment property, it's pretty much their cash flow. They have a job, or they have other investments, and they've got a credit rating and those things they look for. As they rely more and more on the income from their properties, then the nature of that changes and how much of that will count and the vacancy allowances and all those things. So this is why every time you're about to do a loan, you got to get back to the well, talk to your mortgage professional, and work out the kinks. And then stuff happens in your life, right? I remember I had a buyer in contract, and right before they closed escrow, they went out and bought a brand new car. Well, of course, the lender does some last minute verifications, and that blew up the whole deal. So if you're thinking about making any financial moves, you got to be a few steps ahead as an investor. Now, Russ mentioned working a couple of years ahead. So sometimes you have somebody who really wants to do it, but they have something in their past. Could be a credit issue, could be the way they earn their money, could be reporting, could be tax returns. Talk about a person who starts there and has work to do. What are some of the things they can be working on so they get in a position to be lendable?
Oh, it's a great point. And the more advanced planning you're willing to do to prepare yourself for max borrowing power, the better. Couple things that stand out right away every time is if you've got investment property or if you're self-employed, tax returns. Working in collaboration with your mortgage professional and your CPA to dig into those tax returns and figure out if there's ways that you could be more accurate in your reporting. There's some areas we've identified on the tax returns where CPAs just think it's no big deal to put this number in if the client doesn't tell them. And in fact, if they took the time to be more accurate, that could give us the opportunity to package that loan in a more favorable way. Other things are if you're doing repairs on investment property and you're writing all of those repairs off in 1 year, and that property was owned for the entire year, that hit of those repairs can appear as a huge impact on negative cash flow for that property. And so there are ways that you can still take advantage of writing off those repairs, but do it in a way that it actually improves your borrowing power. So these are things that I'm a part of a strategy team that Russ is working with that's teaching us, and we're getting in there and figuring it out together best practices for how we can approach financing, tax strategy, asset protection, and different retirement planning, different areas, so that it's not just one person, one loan officer making the best decision for one transaction and one loan, and not thinking about the impact on tax or estate planning or these other areas, or vice versa, right? The CPA wants to report a tax return and get the most write-off and not thinking about the impact it's going to have on the client's borrowing power. So by working together as a strategy team, we're able to come up with kind of the best practices of here's how to report that in a way that's a win-win for everybody, tax and borrowing power.
Well, we're big fans of the team approach in all of real estate investing, but I love the fact, and it's a really unique selling proposition, that you do have this team that includes a tax professional, an attorney. Sounds expensive, but it's really not, because there's so much added benefit. We'll talk about that when we come back, but before we take our break, one more thing I wanted to get out, and that is credit. People get a free credit report monitoring service and they go, oh, look, I have this as my credit score. And then sometimes they're surprised when they sit in front of the lender and you run a credit report and it looks different. Can you explain that?
Yeah. So lenders have a particular FICO scoring model that they use when you apply for a mortgage. And so their score for a mortgage, they're going to take the middle score of the three bureaus, all ran through this FICO scoring model. So it will be different than what you see on, annualcreditreport.com or something like that, where you're pulling your credit report. And it's important to take a look at your credit report, especially with the advanced planning, and start thinking about what moves you could make to improve your credit score. Lots of times it's not rocket science, but it's easy to get lazy about it. And if you stop and you talk with your mortgage professional and just take a glance at that and identify some things you could do, you'll keep that credit score up. And it really is important, because when you go to price a loan, there's what's called loan level price adjustments. Every time there's going to be loan level price adjustments for your FICO score. And so the higher the FICO score, the better pricing you're going to be able to get on all of your financing. And one of the things we do is when we pull pricing on a loan, if we see, hey, if we can just get this score up 2, 3, 5 points, we can improve, make a big impact on pricing on this, then we'll look at, hey, maybe we can make a move and rescore the credit report and in fact save hundreds, if not thousands of dollars for this borrower. And it makes a big impact if that's not just one loan, but you're refinancing 6 loans at the same time. Let's say that same higher score has impact better pricing on all 6 loans.
All the more reason to talk to your loan professional early. Our guest today is Stephanie Riley. She's an equity strategist. We'll talk about the team approach, and we'll play real estate trivia next. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Live nationwide, you're listening to the Real Estate Guys. Find out more at realestateguysradio.com.
Hey, ever wished you could go back in time and do some tax planning? Now you can, just like Marty McFly. Lucky for you, a brand new federal law just made this possible with an EQRP to get tax deductions and reduce your taxable income from last year, so you can use that tax savings to invest in real estate, Bitcoin, gold, even your own business. Whether you're a full-time investor, doctor, government employee, even if you have 5 or 50 employees, the EQRP works and is your secret weapon, and now it's retroactive. Hey, I'm Damian Lupo, and we have your solution. By the way, if you got bad advice and used an IRA for an apartment syndication, you are sitting on a UBIT time bomb. But don't worry, there's a solution, the EQRP. The EQRP company is ready to help you get control of your money, kill UBIT, and help you pay way less taxes. Want to learn more about this strategy? Send an email to eqrp@realestateguysradio.com for my special EQRP report. Paying tax or letting Wall Street suck you dry is dumb. Your first step is freeing your retirement money by sending an email to eqrp@realestateguysradio.com today.
Forbes rated Memphis the best cash flow market in the nation. And our good friend Terry Kerr at Mid-South Homebuyers has been the premier turnkey rental property provider in Memphis for over 13 years. With an A+ rating for the Better Business Bureau, Terry has renovated over 750 houses. Real Estate Guys listeners have snapped up hundreds. Discover what these satisfied investors already know. Mid-South's properties are completely renovated with a 1-year warranty and a lifelong rental guarantee. They're affordable, well-managed, and easy to own. Perfect for beginning investors and veterans alike. Get in on the action. Contact Terry and his team via email at midsouth@realestateguysradio.com.
Hi, this is Sam Freshman, author of Principles of Real Estate Syndication, and you're listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. Hey, if you ever wanted to do bigger deals using other people's money, or you're a passive investor and you want to get alongside some awesome, experienced folks, then come on out to the Secrets of Successful Syndication, our 2-day event scheduled for March of 2022 in Dallas, Texas. You get all the details on the website at realestateguysradio.com. Under events, we're talking today about managing your equity, your balance sheet, strategically looking at different ways to finance property. Before we get back to our conversation with Stephanie Riley, it's time to play Real Estate Trivia. Your chance to win a prize by answering a trivia question that is real estate related. It's going to sound more loan related, but it really is real estate related, as you'll see. As soon as you hear the question and think you know the answer, send your best guess to trivia@realestateguysradio.com. Trivia@realestateguysradio.com. You can just send us your name, the answer to the question, and your physical mailing address. Because if you're the first to get it right, we're going to send you an awesome book that you're going to love. It's called The One Thing That Changed Everything. That can be yours if you know today's real estate trivia question. Last week on the show, we were talking about safety and security for real estate owners and professionals. And we asked this: for 2020, which U.S. state was deemed the safest? Well, according to the Consumer Affairs Research Team, it's the state of New Jersey, followed by New Hampshire and Rhode Island. They used recently released data from the FBI and the U.S. Census Bureau to score each state based on violent and property crime rates, the number of law enforcement officers per capita, and law enforcement budgets. Here's our real estate trivia question for this week. The Fannie Mae Freddie Mac conforming loan limit is dependent upon where the property is located, and it changes over time. For most parts of the U.S., the limit for 2021 on a single-family house is $548,250. But it's more than that for pricier areas. What's the highest current limit for 2021? And there's 4 or 5 different limits, but what's the highest one? If you know, or just want to take a guess, send your best guess to trivia@realestateguysradio.com. Send us your name, your mailing address, and your best guess. The first person that gets it right gets the one thing that changed everything. That's today's real estate trivia question. We're talking today with Stephanie Riley about not just financing property, but thinking different about the ways that we finance property. And Steph, before the break, we were talking about this team approach, and this is really unique. You know, we have often, as the real estate guys, told people, you got to talk to your lender, and you got to talk to your tax professional, and you got to talk to your attorney, and you got to talk to your estate planning attorney. And, you know, you do those on individual calls, and by the end, you're confused, and sometimes their advice conflicts. And a thing we started in suggesting to folks many years ago is, as expensive as it sounds, get all those folks on the phone at the same time and get it done quickly. And it's amazing. And having people actually having gone through that and followed that advice, and we do that, it is such a time and money saver. But you've really taken this to kind of the next level in terms of this mastermind you put together. Tell us how that works.
Yeah, so this mastermind is a group of these professionals in each of their niches, and we come together and we work out on behalf of all the clients different strategies that can take advantage of the tax, the asset protection, the estate planning, the retirement, the financing part of it. And then each of us are equipped to come back to our clients with better creative ideas of how to put their whole portfolio together. And for clients, we actually do that live with the client. So for clients that have closed loans with me, I invite them to come into that, and we sit down. If their CPA wants to join, that's great. If their asset protection attorney, estate planning, whoever they want to bring is welcome to come. Oftentimes, folks will want to meet with our network of advisors, and we'll sit down and we'll look at their situation. And oftentimes, the client will share what their hopes, dreams, goals are, what their fears, their concerns are, and then they sit and they really listen to the advisors going back and forth with each other, saying, well, if they did that, they wouldn't qualify for the next purchase. They really need to take a look at this. Oh, well, if they did that, then they wouldn't be able to take advantage of this tax benefit that may not be happening next year. So they really need to do it now. Okay, well, what if they did it like this? And we start to put our brains together on your particular situation. And it's just huge fun, huge learning. And at the end of the day, you walk away as the beneficiary of one of these meetings. You walk away feeling really confident that you're getting the most out of your portfolio and you're doing it in a way that is more secure. Nothing's guaranteed, but you're doing it in a way that is stabilizing your whole portfolio.
We don't normally think about accountants and lawyers being all that creative, but it does happen when they start to get in a room and talk to each other and banter back and forth. We just saw this happen at the Secrets of Successful Syndication. CPA Tom Wheelwright got on the stage, and then we had Eric Oliver, who does cost segregation, and Tom jumped back up there, and he was impassioned about sharing about it, and they're on the same team, if you will, trying to educate people about how to use these great tax strategies, but that synergy that gets together is amazing. And so hats off to that idea. That's something that cool. That how it worked traditionally is your lender, the person that you deal with. It could be a representative from a bank. It could be a mortgage lender. They're going to go to their underwriter or underwriting committee and get some feedback on loans. And of course, they're looking at loan programs and the changing products that are out there, and they come back with their best guess. But it doesn't generally take into consideration long-term asset protection and estate planning. It doesn't take into consideration not just taxes this year, but how it's going to look in subsequent years as we're trying to build up our portfolio. And I think that's the real value add. And I know you've had some clients that have discovered things during these sessions that they might not have otherwise known. And that's always illuminating. We've talked to a couple of folks that are like, wow, I had no idea. Well, I'm not sure anybody had the idea. It was all these great minds coming together that was the germination of the idea.
Such a good point. It really is. It's the minds coming together. And it's hard to put into words how powerful this is, because you're exactly right. You walk away and 9 times out of 10, you walk away with an idea that not only had you not thought of, but maybe no one on the team had thought of independently. The idea came because of the collaboration, the conversation, the synergy, the discussion, and that's really fun.
Well, and I know Russ gets juiced on this. He doesn't participate in every one of these, but he's certainly been a guiding force in kind of bringing some of these folks together, and his brain works differently, right? The financial strategist, and that's why you have to think about not just a moment in time, not the property I want to buy today. As real estate investors, we got all excited about the property. Oh, I found this great deal. Okay, well, that's awesome. And you should be able to pursue a great deal, but it has to be in context of, one, how am I going to be able to afford it? What loan's going to make the best sense? And then 2, how's it going to affect everything else I do? Many people are pursuing real estate because they want that monthly cash flow, and or they want to accumulate more assets over time. You do bump into some limitations, and we talk about getting Fannie and Freddie'd out, but no investor left behind. Explain what happens when a borrower acquires more and more property. What are the things that happen in terms of their eligibility for loans?
Yeah. It's definitely a wall that folks can run up against. So for Fannie and Freddie guidelines, they want the borrower to have no more than 10 residential financed properties. Now, here's where we can get really creative, is we can separate who is on which loans with, let's say, a husband and a wife, spouses. We might put one spouse on the first 10 loans and then the other spouse on another 10 loans. So together, as a family, they can get 20 Fannie Freddie loans. And why is it such a big deal with Fannie and Freddie? They really are the cheapest, most favorable term loans out there. Although there's other options that aren't bad. But so you could get to 20 loans as a family. Now imagine each of those properties are fourplexes. Now you've got 80 units financed with some of the cheapest financing available. And so building your portfolio in a way where you're not just thinking about how can I package to qualify, tax returns and all this stuff, but who does really need to be on this loan? And then which person do we put on which loan? And I know that can get technical, but because there are some loans available that you don't qualify, even in residential, you don't qualify based on your employment and income. You qualify based on the cash flow of the property, very similar to how you'd qualify for a commercial loan. So you have to meet a debt coverage ratio. Now, those loans, because you don't need employment and personal income, if we've got two spouses and one has employment and income and one does not, we might use the employment and income to do full doc financing with one spouse. And then anytime there's a property that cash flows at a level that could meet the debt coverage ratio for some of these other products, we could strategically use the spouse that doesn't have the income and employment to get that financing. And so how you do it, the order that you do it in, is really important to be able to get the most financing you can at the cheapest overall cost at the highest leverage ratios.
All right, great stuff. You know, back in the day, we made it a habit to do these cash out refis. We get some equity in a property. We want to access that equity, turn it into down payments on additional properties. We called it rabbit investing. Then all of a sudden, there were no cash out loans of any kind. Now the landscape has changed back a little bit, and you've actually written a report about this. We'll tell listeners how they get a copy of it in a minute, but tell us what it looks like today, ways for people to harvest and utilize the equity they have in real estate.
Yeah, it's a great point. I remember those days when credit markets seized up and cash out refis were no longer a thing overnight. And it's really a great point of why we could not be better positioned than we are right now to harvest equity in our properties. The credit is available, the rates are so cheap, and the equity is all-time high. The appreciation is ridiculous. And so it's the perfect time to cash out refi, protect that equity. And currently, if you're looking at conforming loans, you can get up to 80% loan to value on a cash out refi with a cheap first. And then you might even be able to put a line of credit behind that. But for sure, 80% is readily available to harvest that equity.
Good stuff. Well, there's some more details involved, and Steph's put together a real cool report. And if you'd like a copy of it, all you have to do is send an email to cashout@realestateguysradio.com. Cashout@realestateguysradio.com. You can learn how to better harvest your existing balance sheet, and then you can find out more about what Steph does. That'll be included as well. Stephanie, great to see you. Great to hear from you. Thanks for sharing today.
Thank you. Great to be here.
There's our friend Stephanie Riley. More when we come back. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Need help with your real estate investment portfolio? Check out the resources page at realestateguysradio.com.
Real Estate Guys listeners, are you tired of losing real estate deals due to financing issues? Have you had enough of waiting on banks, lenders, and investor groups to fund new projects? What if there were a way to eliminate all the hassle and invest in real estate on your own terms? I'm here to tell you there is. Patrick Donahoe here from Paradigm Life. I'm an Investopedia Top 100 Most Influential Financial Advisor, and I recently wrote a best-selling book about the financial strategy that changed my entire investment model, and the one that could change yours. To get a copy of my book for free and learn how you can maximize your real estate portfolio by acting as your own bank, send an email to mybank@realestateguysradio.com. Don't make another real estate deal without reading my book first. Email mybank@realestateguysradio.com now to get your copy for free.
If you love real estate and have always wanted to own your own business, listen up. The Real Estate Guys and their panel of experts want to teach you how to go full-time fast in the real estate syndication business. These next few years may go down in history as one of the best times ever to acquire investment real estate. There are deals everywhere if you know where to look and how to assemble the resources. The Secrets of Successful Syndication seminar will show you how to make big money doing big deals from a team of experts that have syndicated projects totaling more than $1 billion. Don't wait for someone to give you a raise or create a job for you. Attend the Secrets of Successful Syndication and learn how to build a team, raise capital, find deals, and make full-time money in 6 months or less. Go to realestateguysradio.com and click on events. All the big players use syndication as a way to diversify risk, optimize profits, and earn big money. You can too. Go to realestateguysradio.com and click on events.
Hi, I'm G. Edward Griffin, author of The Creature from Jekyll Island, a second look at the Federal Reserve. And you're listening to The Real Estate Guys.
And welcome back to the Real Estate Guys radio program. Hey, if you lack clarity in your life, if you want more out of the future than in the past, then come to Create Your Future, the 2.5-day goals retreat that happens at the beginning of the new year. All the details on our website at realestateguysradio.com under events. We're talking today about managing your equity and getting loans on property, and what a whirlwind. Great to hear from Stephanie.
It brings back so many memories, and I'm just sitting here just like jumping out of my skin because there's so many points in the conversation where I just wanted to dive in. Being part of this mastermind that she referenced, where we're integrating all of these different disciplines into portfolio management and really managing the borrowing power. You talk about beginning with the end in mind. A lot of people just begin at the end, right? We talk about that all the time with personal investment philosophy. People buy the property and then they figure out the team. Then they realize they're in a good market or a bad market, and they develop their philosophy often on the backside of pain. If you begin with developing your philosophy first and then pick a market and a team that fit, you're going to end up in properties that are really going to fit. The same thing is true here. Right? Everything begins with the end in mind, but you do have to begin at the beginning, and you have to begin to create this. And number one, it starts with developing a team that is going to support you. Rich Dad, Poor Dad really came out with the concept and really taught better than anybody else I've ever seen the relationship between your balance sheet and your financial statement. And that your mission is to build a balance sheet that feeds your financial statement and to use your financial statement or your cash flow statement to feed your balance sheet. That's what this is all about. But to do it, you've got to understand how each of these different disciplines affect it, right? If I go in and I have a bulletproof asset protection where I control everything and own nothing, and then I show up to get a loan, I look dirt poor. I have no reserves. I have no leverageable assets. So I can't build wealth with a fortress. If I manage my tax to where I've got no income, it's great for tax, but the problem is now I can't qualify for a loan. And if debt is the number one way I accumulate tax breaks, income, and equity growth, I have to be lendable. The other big part of it is why we've been so emphasizing residential real estate of late. We saw what happened during the COVID crisis. Certain aspects of real estate completely died. Retail, office really got hit. Distribution worked out great because they were the recipient of it. But one of the most steadfast, stable places you can be in investing in real estate is residential. And yet cap rates in apartments are just down to nothing. So there's big opportunity. We've been talking about build to rent. We've been talking about residential. We can see the migration patterns. We know that there's a housing shortage. That's creating a lot of equity, as Stephanie alluded to. And how do you leverage what you have to go get more? That's what this is really all about in a very integrated strategy. It's super exciting, and I'm really happy to be a part of it.
It is cool, and it really is the necessary linchpin to go from just your average and ordinary investor mentality to really being able to explode what you do. And it's just a little bit of knowledge and education. And as Stephanie talked about, synergy, that team approach. It's a lot to comprehend, but the great place to start is with Stephanie's report. If you'd like a copy of that, just send an email to CashOut at realestateguysradio.com realestateguysradio.com, CashOut at realestateguysradio.com. Even if you don't yet own a property to get any cash out of, you're probably going to want to get to the report and get connected to Stephanie. Never too early to talk to your mortgage professional. Hey, speaking of not being too early, it's definitely not too early to get signed up for the 2022 Investor Summit, our 20th annual Investor Summit. It's going to be incredible. Nearly 70% sold out already, but there's room for you if you're quick. You can find out all the details on our website at realestateguysradio.com under the button that says Summit. Next week on the program, we're going to talk about an easy, no-hassle way to invest for folks that are super busy but want awesome returns. Until then, go out and make some equity happen.
This episode of the Real Estate Guys radio show is brought to you by Paradigm Life. Powerful cash management strategies using life insurance. Learn more at beyourbank.com. Mid-South Home Buyers. Low-cost, turnkey cash flow properties in Memphis, Tennessee. Corporate Direct. Asset protection strategies for real estate investors from attorney and Rich Dad advisor Garrett Sutton. Find these and other great companies under the Resources tab at realestateguysradio.com. To learn how you can expose your product or service to the Real Estate Guys audience, call 888-489-7723 extension 4. That's 888-489-7723 extension 4. Or use the feedback page at realestateguysradio.com. Thanks for listening, and we'll see you next week right here on the Real Estate Guys Radio Show.